We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrowicz. Joining me today is Peter Schiff, CEO and Chief Economist of Euro-Pacific Asset Management, also the chairman of Schiff Gold and the host of Schiff Radio. Peter, it's a pleasure. Thanks for joining me today. How are you?
Oh, I am doing okay. Thanks for having me back on your program.
Always a pleasure to have you and to have you make some time for us. And I'd like to kind of start today by kind of separating a giant topic that I think it is going to be quite important to pay attention to, and that's this topic of inflation. At this point, how do we try to separate, let's say, the causes of inflation in the economy, and is it important to be distinguishing what is causing inflation, whether it was this monetary type inflation after COVID, reshoring inflation, or tariff inflation?
Yeah. Well, I mean, first of all, you have to understand what inflation is to know what causes it. And there's only one cause, and there's only one type of inflation. Mm-hmm. So that the word inflation comes from the word to expand, right? That's what happens when you inflate something. If you inflate a balloon, the balloon expands, right? Prices don't expand. Prices can go up, prices can go down, but you can't expand a price. So the word inflation is not even referring to prices. That's not the origin of the word. It's something that's expanding. Well, what expands? The money supply. The money supply can expand and it can contract, right? The Fed can put money into circulation or it can take it out. When money supply is expanding, that's inflation. When money supply is contracting, that's deflation. Mm-hmm. Now, of course, the supply of money is going to impact the price of goods and services, right? So the more money there is, all else being equal, the higher the prices are going to be. The less money there is, the lower the prices are going to be. So when the government is creating inflation, prices will be higher than if they weren't creating inflation. Now, there are, counterbalancing forces that impact prices. Inflation pushes prices up, but productivity pushes them down, mm-hmm. right? So a free market is always coming up with better, more efficient ways of producing goods and services. So absent any inflation, the natural tendency of prices is to come down over time. Now, if the government creates inflation, it could prevent that process from happening or reverse it. So let's say prices should have fallen by 5% in a given year because of increased productivity. But the government expands the money supply, and so prices don't fall by 5%, they rise by 2%. Now, somebody would say, oh, we have 2% inflation. No, we don't. Without the inflation, prices would have gone down 5%. So the government robbed us of 7% of our purchasing power by creating inflation. Mm-hmm. Now, the reason that the public believes that inflation is rising prices, when rising prices are just a potential consequence of inflation, is deliberate, I think, on the part of the government and, with the help of academia and Wall Street to redefine inflation to help obscure the cause, right? Once you understand that inflation is the expansion of money supply, well, you know who causes it. It's the Federal Reserve, right? Mm-hmm. It causes it. But if you think inflation is rising prices, then you can blame the grocery store, right? For gouging you. Mm-hmm. You could blame the companies that are raising prices. Or you could blame labor unions for demanding higher wages. And that serves the government's interest because they don't want the public to know that they are the source of the inflation. And inflation is really a tax, if you understand it, because the government creates inflation just the way it lays taxes, except it's a secret because people don't realize. But most of the money supply growth is to fund deficit spending. So if the government ran a balanced budget, the Federal Reserve wouldn't have to print so much money, and so prices would be lower. But because the Federal Reserve constantly buys U.S. government debt, there's more money, and so there's higher prices, and so that's a tax. Instead of sending the government our money, they take our purchasing power. They just do it surreptitiously. Now, of course, it's not just the money supply that expands, it's credit, right? Because credit is also money in the sense that you don't need money to buy something. You could buy something with credit, right? And so if there's more credit, then there could also be higher prices because people take that credit, they go to the store and they buy stuff the same way they would if they had actual money. And so credit has been very loose in this country because of Fed monetary policy. Interest rates are too low, so credit card debt is record high, household debt, government debt. So there's a lot of extra credit that is also pushing up prices. So you can say inflation is this increase in the supply of money and credit, and that's what's increased. And if you want to know what's going to happen to inflation or what's going to happen to prices, what do you think is going to happen to the money supply? It's going to go up. They're going to keep on creating more money. They're going to keep on easing credit conditions. And so prices are going to go up. Prices are going to go up more in 2025 than they did in 2024. That's going to be very disappointing to a lot of people who voted for Trump because they thought he was going to end inflation. He's not. Inflation's here. It's going to get worse in his first year, and I think it'll be worse still in his second year. And that's because the deficits are exploding out of control. We're now borrowing or paying over $100 billion a year just in interest on the debt. And since we're running a $2 to $3 trillion budget deficit now, all of the money to pay that interest has to be borrowed. And so we're now adding $1.2 trillion a year to the national debt just to pay the interest on the national debt, which is phenomenal. And of course, it's not stagnant. By the end of next year, we'll be spending $2 trillion a year just in interest on the national debt. Right? That means even if the budget was balanced, we'd have a $2 trillion debt. If it was balanced, but for the interest on the debt, which it won't be, it's going to keep going up because Social Security, Medicare, government pensions are going through the roof, the cost of financing those. Plus, military spending and all sorts of programs, despite the good work being done by Elon Musk and the Doge boys in ferreting out corruption and fraud and waste, which is rampant in any government. I mean, it's not unique to America. That's just the way government works. You always get the fraudsters and the con men that are attracted to government. Power corrupts. And, so those seeking power are generally corrupt. And once they get the power, they get corrupted by it. But it's not going to be enough to offset all the increases in government spending that are going to continue. Even if we manage to get rid of some, we'll never get rid of all. But even if we get rid of most of the fraud and the abuse of the waste, government deficits are going to rise. The Fed is going to go back to QE. In fact, the money supply still grew about 5% last year, even with quantitative tightening. So we're growing the money supply. It's going to grow faster in the years ahead. And so prices are going to go up. Now, if we can roll out a lot of AI and that AI can dramatically increase productivity, then maybe you won't see the price increases as much. But what you'll miss out on are the price decreases that otherwise would have occurred. Now the government tries to get us to think that prices going down are a terrible thing. Like, they have to save us from that disaster. That's why they say they need 2% inflation. One of the reasons, they say because they can't let it go too close to zero because then it might go negative and then that's going to be a complete disaster. I mean, imagine how horrible it would be if all the things we needed became more affordable. What if education was cheaper? What if energy was cheaper? What if healthcare was cheaper? See, that would be a real disaster. And so the government wants to save us from that.
Do you think?
Yeah, I mean, so.
Do you think that the Fed has accepted a new floor, let's say, of 2% rather than trying to average out 2% for inflation now?
Well, the average inflation lasted for just a few months, and then the Fed put that away as soon as they realized how high inflation was. But the interesting thing about this 2% inflation target is it never existed when inflation was above 2%. The Fed only rolled it out when it was like 1.5%. And they said, hey, we don't have enough. We need to get it up to 2%. But when it was 3 or 4, they never said, oh, no, we need to jack up rates to get it down to 2%. Right? They only invented the target when it served their purpose, which was to create more inflation. But now they're kind of stuck with it. And so, but I don't know that we're ever going to be back at 2%. So either they're going to raise the target, which for now they're saying, no, we're not going to do. They could, of course, jerry-rig the CPI again to rig it so that the numbers are lower. They already did that with the Boston Commission. So even when inflation is measured by the CPI, right, even when it was 1.5%, it was probably 3 or 4. So we never really had inflation below 2% anyway. Where they got this 2%, right? They got it from the Central Bank of New Zealand, which introduced 2% as a ceiling in the 80s. And it was a ceiling, not a target. So it wasn't like if inflation is 0.5%, you need to get it up to 2%. It meant if it was 0.5%, everything was good, no problem. But if it got close to 2%, they had to do something because it had to stay below 2%. Right? It was never, try to get it up there. It was, the lower the better. But they took that and redefined it, as their mandate. But they have no such mandate. They made it up. Their mandate is price stability. Prices that go up 2% a year are not stable. They're going up every year. Stable, if you go to the dictionary and look it up, it's like it's the same, unchanged. So the target should be 0. Right? If they want stability, not 2%. And yeah, I mean, if some years prices go up 2%, they should have to go down 2% the other years in order to keep it stable, right? So
I remember at one point being part of a meeting where I asked this Keynesian economist why 2% is a good target to have. And the basic answer that he gave me was so that we have room to be able to play back and forth to avoid recession, to be able to stimulate or to, adjust that thermostat perfectly because we know better than the market. And
that's assuming that you want to entrust the economy to a handful of bureaucrats who think they know more than the market. I would rather have sound money. I don't want central government planning. I don't want to deliberately create inflation just so these idiots think they have extra room to micromanage the economy when it's in a recession. What if that recession is necessary and by inhibiting it, they actually do more damage? Let the recession run its course and let it, fix the problems that led to the recession so that we can have a real recovery instead of a bubble, which is all we get from the central banks, right? What they do is they create bubbles. Right? They don't solve problems. They create bigger problems.
Well, I ended up rephrasing that question to him by saying, why is it okay for you guys to be stealing 2% of our purchasing power instead of trying to peg it at 0 and using that as the average? But I got basically the same answer. And I totally agree. This idea that this group knows better than the entire market just
and why,
doesn't seem plausible.
Why should the central bank even be picking interest rates? Why don't we have a government bureau to set the price of food, bread, corn, wheat. I mean, food is important, probably more important than, the interest rate. I mean, we get without food, we're going to starve to death. So why don't we have the government picking the price of food? They should pick the price of money, of interest rates. Why not the price of energy? Why don't we have a government price bureau for everything? Oh, well, yeah, they tried that in the Soviet Union. It doesn't work. Right? You need the free market. You need price discovery. We don't have that in interest rates. Now we have it more on the long end, but now the Fed has its thumb on the scale by, doing QE and stuff like that, which I think they're going to do because long-term bonds have been rising, the yields, and I think they're going to keep rising. But I think short-term rates are still too low. I think if the Fed took its thumb off the scale And if the Fed made it clear, in fact, if the Fed made it clear right now, we're never going to do more QE, I think bonds would go down and yields would go up. I think, people still think there's a Fed put out there in the bond market, and that the Fed's got everybody's back.
Well, Peter, this idea that the Fed has perfect data and, reacts or is completely data dependent all the time is seemingly a very challenging idea. It seems like they're getting contradictory signals from the market. For example, like the rising PPI, as you've recently pointed out, that should make rates go up, but yet we're unchanged again, right?
Yeah, the CPI, we got the CPI yesterday or 2 days ago, and it was up 0.5% on the month. That annualizes to 6% inflation. I mean, were they talking to? In fact, if you annualize the last 3 months, it's 5. And the last 4 months, sequentially, every month is higher than the month before. So inflation is going up. It's not headed down to 2%. It's headed back up to 9%, right? Yet the markets, the Fed, they're just, I guess they're claiming it's transitory again, although they don't want to use that word because it really burned them the last time that they did. But yeah, inflation is got no place to go but up, because the deficits get bigger and bigger, and the next recession is going to be worse than the last. And like any drug addict, you every time you come down, you need more of the drug, right? Because your body builds up a tolerance, and you keep needing more and more. Well, as the U.S. economy gets deeper into debt, we need more and more stimulus, right, to be able to handle it. And so that's why, the last time we did QE, we did more QE and QE4 than QE 1, 2, and 3 combined, which is what I was predicting. And I think the next time the Fed goes back to QE, they're going to double the balance sheet again. So right now it's back below 7 trillion, I think, or is it below? Or let me see. I think it's just below. I think they just got it below 8 trillion. So it's like below 7. It's 6.8 trillion. So it was 9. I mean, they've managed to reduce it quite a bit, actually. But I think they're pretty much near the end, and they're going to go reversing it. And next thing you know, it'll be 15 trillion.
So if they go back into, or go back overtly into expansion of the money supply, and let's say we do get some type of a recession and they slash rates, does that end up serving Trump's aim of having a lower dollar, which is better for trade for the U.S.?
Well, a lower dollar is going to, make the inflation problem worse. One of the main reasons that prices eased, from 9% year over year to 3% was the strong dollar that kept a lid on prices. But they've already blown off that lid. I mean, the CRB index is up 25% now since the first of last year. So this is exactly how it started last time. You saw it in commodities first, and then it's bled into, the price level. But commodity prices went up first, and that's exactly what you're seeing. The only commodity that really hasn't taken a big move up is oil, and I think that's coming. But a lot of the other commodities have already moved. But the powers that be are oblivious. Maybe it's just wishful thinking. They just want to hope that this is just an aberration, but they're continuing to pretend that they got it all under control, which they don't. I mean, I pointed out the Fed never got to restrictive territory. I mean, they claim that they did, but they didn't. Rates never got high enough, and then they started cutting as soon as the banks started failing, and that just shows you, how vulnerable the banks are to rising rates. And in fact, the one thing that would cause all the major banks to fail would be stagflation. That's why the Fed doesn't even test for stagflation, and it's stressed. The most severe economic condition that the Fed could imagine is when interest rates and inflation go way down. That's the worst that they can imagine. right? They think a situation where inflation and interest rates go way up and the economy is weak, they think that's an impossibility, right? So in other words, they think what happened, let's say in the 1970s, can never happen again. Now, obviously it can happen again. That's just the Fed just doesn't want to call attention to the fact that every bank would fail if it did. And that's also why they don't have a contingency plan for stagflation. When Powell was asked in one of these press conferences, what's your plan for stagflation? He laughed it off and said, well, we're just going to hope we don't have it. So he doesn't have a plan because there's nothing the Fed can do. They're powerless when there's stagflation. So that's where we're headed, because the next recession, the problem is the deficit's going to explode. The big problem with bond market is the enormity of the debt. And so if we have a recession that drives the budget deficits from 3 to 4 trillion to 5 or 6 trillion, I mean, you're talking just astronomical amount of debt. Plus every year there's another 10 trillion or so that matures that has to be rolled over. So the funding problem is going to explode during the next recession, which I think is going to put upward pressure on interest rates. And that means the Fed's going to have to get even more aggressive to stop rates from rising, which is what their goal is. In a recession, they want to lower rates and they have to print money and buy bonds. But they were able to do that, when inflation was relatively low, and they can hide it behind the rigged CPI. But it's not going to work next time. Inflation is going to be high. And if they do this, it's going to be a lot higher. And then it could create, a real run on the dollar. I mean, gold's, just below $3,000 an ounce. I mean, this is not happening, this is not a pure coincidence that gold is, almost $3,000 an ounce. When I started telling people to buy it because I saw a monetary crisis coming, it was $300 an ounce. So it's 10x'd. Now, we haven't had the monetary crisis yet, but it's coming. And it's going to be worse now that we were able to delay it for as long as we did, because during that delay, all the problems that make it inevitable got much worse.
Peter, what's your take on, let's say, the Deepseek news, as you brought up that AI idea? It really didn't have much of an effect on the NASDAQ, and it seemed that it should have sent, let's say, stocks like NVIDIA down much sharper than it did.
Well, it's hard to say. I mean, obviously, I still think there's a bubble in AI. Not that I don't think AI is real. And in fact, we may even be underestimating the impact it's going to have ultimately on, our way of life, our economy. But, like most things that have to do with technology, it gets improved. And what are the odds that, 5 years from now, you're going to still need these expensive NVIDIA GPUs to make AI work? Maybe we'll have a more efficient way of doing it. There'll be more competition for those GPUs. Maybe a lot of the companies that are spending so much money buying them will start building them themselves, and not buy them from, I remember during the dot-com bubble, the big stock that everybody had to own was Cisco Systems, because they made all these routers and all the things that you needed to build out your broadband or but the whole nature of the internet changed. The internet got a lot more efficient. People didn't need all that hardware anymore. And the next thing you knew, they were competing with themselves. They had used hardware on the market. A lot of the companies they loaned money to went out of business. They vendor financed a lot of stuff. So Cisco Systems is still trading for less than it was back in 2000, So the same thing could happen to some of these stocks like NVIDIA. It turns out that, they made a lot of money, but, the margins aren't sustainable. You can't keep making that money because you're opening up a window for people to come in and compete and innovate. And what happened with Deepseek is, look, hey, here's the Chinese came up with something that's more efficient, less energy. But I think the narrative right now is that, okay, great. That just means more AI, because if it's more efficient, more people can build it out, more demand for, these GPUs. And
when we're talking about these crazy valuations of companies, something like Palantir, which is trading at something like 600 times earnings right now, do you think that attribute some of that overvaluation to passive flows just going into buying the momentum in, names like this, no matter the fundamentals behind them or the actual valuation?
Yeah. I mean, I think the Federal Reserve, with all the cheap money, has turned the stock markets into a casino. And I don't think there's a lot of actual research that goes into buying stocks. I think people just buy what's going up. They buy whatever has the sexiest story, right? The old saying on Wall Street is you sell the sizzle, not the steak. Well, in a lot of cases, there's no steak there. It's just sizzle. Mm-hmm. And the epitome of that is the crypto market, right? I mean, look what's going on there. Look at a stock like MicroStrategy. Now GameStop comes out yesterday. We're thinking of buying Bitcoin with our money. So the stock will go up. I mean, people just buy ticker symbols, or they buy, a crypto just because they think it's going to go up and they want to get in on it, right? Mm-hmm. Everybody wants in on the action. And everyone's afraid of missing out on the big gains. So it's just one gigantic casino. And the problem with that is you end up getting a big misallocation of capital, because all the capital flows into the bubble. Mm-hmm. And it doesn't go to where we might need it. I mean, we have a record trade deficit now. The trade deficit that we had in December, merchandise trade deficit, 122 billion. We've never seen anything that bad. I mean, we came close 1 month when we reopened the economy after COVID, but that was an aberration. Mm-hmm. Now this is just standard operating procedure. But one of the reasons that our trade deficits are so big is because instead of investing in the factories that build the products that Americans actually need and want, mm-hmm. we're wasting money creating cryptocurrencies that nobody needs or whatever else we're funding.
What do you mean? We don't need fart coin?
AI building. Yeah, you can't, but so it's a misallocation, and that is being fueled now by the government, because Trump embraced Bitcoin, and now you have all these politicians talking about setting up Bitcoin reserves and using taxpayer money to buy Bitcoin. Now more people want to buy into it so they can sell their Bitcoin to the U.S. taxpayer. So that's sucking in more money into this, Ponzi. But it's all to the detriment of the economy, because money that's used to fund this nonsense, doesn't go into the real things that we need to be making. And mm-hmm. so we become more and more reliant on the countries that are making those things.
Do you think Trump's threats with these tariffs is going to be a good way to combat this trade imbalance? Or,
no.
Is there a fine line that needs to be struck there before you start alienating people and they find other markets to sell to?
Well, first of all, you alienate people just by making the threats. Mm-hmm. And of course, if they're just threats, then they really have no impact, right? Because they're never actually imposed. But to the extent that we get all the tariffs that are being threatened, it's not going to solve the trade deficit. I mean, is it possible that we have a somewhat lower trade deficit as a result of the tariffs? Sure. Because tariffs makes imports more expensive. Mm-hmm. Now, in some cases, people will buy domestically produced goods that are a little bit more expensive, or much, depending on the tariffs. They'll pay more money for those goods than what they were paying to get the imports. But in some cases, they'll just be priced out of the market entirely, and Americans will just not buy those things. Mm-hmm. But yes, we could have a smaller trade deficit as a result of the tariffs, but I don't think it would be significantly smaller, because I think at the end of the day, there are no real viable U.S.-made substitutes for most of what we import. And a lot of the categories of our imports, we import 70, 80, 90% of that stuff, right? And so if we made those imports very expensive, the small capacity that we have to produce those goods could not be ramped up, So the domestic producers could jack up their prices quite a bit and start making some money. And that may eventually, encourage some capital to move in, but some capital might be reluctant, because, what if you invest a bunch of money in a high cost U.S. plant and then the tariffs are removed and then you're screwed, right? Because they can go away at any moment. So it's really hard to invest in an industry that is dependent on tariffs that can go away with the next administration. So I think what the main thing that's going to happen with tariffs is that the imports get more expensive. And but we're still going to have big trade deficits. And the negative of the tariffs is there are, some U.S. companies that may become less competitive because of the tariffs and how it affects their imports. And especially when it comes to exporting. So if American companies that are trying to compete and we want to export our products, to make those products, if we don't get a credit, now maybe they can arrange so if you export something, you can get a credit for the tariff you paid. But I mean, if we don't have a credit, then that tariff's going to be embedded in our export prices, which could make them less competitive on global markets. So, there always could be unintended consequences of the tariffs. But the bottom line is we don't have trade deficits because our trading partners have tariffs. That's not why we have them. We have trade deficits because it's cheaper for us to import stuff than to make it ourselves. Right? That's the reason. And the tariffs don't change that unless they're high enough so that now it is cheaper to make it. But it's still going to be a lot more expensive than it was. And so that means prices will be a lot higher. And a lot of people just will have to stop buying stuff.
One of the last things I wanted to touch on here, Peter, with you before we get to gold and the gold story is I know that you pay attention to the yield on the 10-year Japanese bond. And that yield keeps climbing as, soon we're going to be at 1.5%. Why could this be so catastrophic for anybody other than Japan?
Well, it's not just Japan that's going to have to deal with this because the low rates, and right now yields in Japan at 1.33. That's the highest I saw was 1.36, but they closed, I think, at 1.35 is I think where they closed the week. But the reason this is so important is, this is a 15-year high. 1.5 may seem low, but it's the highest in 15 years, right? So talk about a society that has grown accustomed to ultra low rates. And remember, for years, the short-term rate in Japan was negative. It's now positive, but it was negative for years. And during those years, a lot of Japanese borrowed yen and then took those yen and invested in all sorts of assets all around the world, the yen carry trade. And there was a positive carry because they were earning more on the assets they owned than the cost of the debt. And of course, the yen was weakening, which, augmented their returns. So let's say the interest rates really start to rise. I think they're going to get to 2% this year and then really start to rise. Now, the cost of funding these investments really starts to go up because now people have to pay much higher yield on the yen. And the yen starts to rise against these other currencies. And so now they start to lose on the FX and the cost of the carry is going up. Basically, they have to start unwinding this stuff. And that means the Japanese become big sellers instead of big buyers of risk assets around the world, including, things that aren't like treasuries. They had a positive carry in treasuries, but that turns negative. And so it's like a major rug pull from all over the world or, a giant margin call. Plus, I think that Japan has got more treasuries than any other nation. And I think one of the things that Japan might do to try to reduce its debt is to sell off its treasuries to pay off its own debt. And so that is also going to have a big impact on the U.S. economy. So it's not just a Japanese problem when they're the big lenders in the world and they're the ones that are, buying everything and they become big sellers. So people have to pay attention to what's going on over there. And these yields, because, the Japanese debt to GDP is like 250%. So you think we have a problem paying high interest. Imagine what the problem is over there. Now, they've got a stronger tax base than we do. The Japanese have more savings than we do. So they're better prepared to handle the crisis than we are.
So, Peter, when we when we've heard all of these threats for the tariffs here, that seems to be one of the, let's say, the proximate causes or one of the rumored causes of the LBMA greatly expanding delivery times and lease rates blowing up. Do you think that this is a reasonable explanation to get gold into the US before these tariffs are implemented?
Potentially. I mean, if the tariffs are applied to gold, I mean, they might be, and if they're implied, no matter where we import it. Now, the U.S. also produces gold, so we have gold that we produce ourselves. Obviously, that wouldn't be subject to the tariffs. But obviously, if demand for physical gold increases and it's beyond the ability of the U.S. domestically to supply that demand, then gold is going to get more expensive if you got to pay a tariff to get it. And that would also probably open up, depending on how high the tariff was, that people might start smuggling gold in and selling it that way, because the black market price for gold would be a lot lower than the legal price, which would include the embedded tariff. But yeah, so that could be a reason, but that would be, the companies that want to sell that want to get it in before there's a tariff. Of course, you could also buy gold and keep it stored offshore and never take delivery of it, in which case it wouldn't be subject to the tariff. So there's nothing that would stop Americans from buying gold and having it delivered to a vault in Switzerland or Singapore, and then you wouldn't pay the tariff. You'd only pay the tariff if you brought it in, right? But of course, you could, try to bring it in, secretly in your pocket or something, and not, if you maybe bring it in less than $10,000 worth at a time, if you make a lot of trips, and then you don't pay any taxes on it. And even people that brought in more than $10,000 worth, they could take a chance that nobody stops them. I mean, But
do you think that there's a better explanation for that delay and that demand for gold from the LBMA then?
Well, it may be that the people who have bought a lot of futures contracts want the gold. Maybe they bought the futures contracts with the intention of taking delivery because they want to keep it. And they thought, hey, I'll buy these gold futures contracts and then take delivery. Because they're not speculators. They actually want to own this gold, and maybe it was less disruptive to the markets to just go into the futures markets than try to buy it on the spot market. So who knows? We'll find out what's going on with that. But as far as our tariffs, like if we had tariffs on gold, see, it's not going to impact Canada. I'd say we buy a lot of gold from Canada. If we have tariffs, so Canada will sell that gold, to China or somebody else. I mean, it's very easy to ship gold, right? Go put it on a plane and go anywhere, right? It's a little bit different, when you're talking about oil, natural gas, electricity, where it's a lot easier for Canada to sell it to the United States than it is to sell it to China, right? But gold, if Americans don't buy it, somebody will. Very easy.
Well, I understood some of the nuance with that was more so on country of origin. So if it was gold that was produced in Canada, let's say, and the US still wanted that gold or for it to be brought in, then there was the possibility that it could be resmelted and recast and brought in under, as being produced from another country, right?
Yeah, I mean, gold is pretty fungible. Obviously, yeah, gold could come in if we said we're not going to take any gold from country X. Well, country Y could buy that gold and just resell it to us. And if they had to melt it down and recast it in their own, mint branding, they could do it very easily.
Yeah.
That already happens right now. A lot of the goods, you put a tariff on Chinese goods, but you don't put a tariff on Indonesian goods. Indonesia just buys a bunch of stuff from China and then resells it to us as if it was made in Indonesia.
Just right? Like Russian energy.
Yeah. Now it's going to increase the cost somewhat. Let's say there's a 25% tariff on Chinese goods. And so they end up selling the goods to Indonesia, and they just change the labels on the garments or whatever the hell it is. And they sell it to us. Maybe we end up paying 10% more instead of 20% more, right? So Americans pay more, and the government doesn't collect any tariffs, right? Because they got no tariffs because we didn't buy it from China. We bought it from Indonesia, but we paid more money for it because it was cheaper when we bought it for. So everybody loses except Indonesia. They win. China, usually this stuff doesn't work. I mean, and then if we go into the trade war, everybody loses, because we all benefit from free trade, and the less free trade is, the more of those benefits we lose.
Well, there was also
the government has to raise revenue. See, you could say, well, is a tariff a better way to raise revenue than an income tax? And I would say yes, because income taxes harm the economy too. I mean, there's no way the government can take money away from the economy without doing harm. Now, you can argue that, well, when they put the money back in, there's some gain, right? And you could debate how much. I mean, I think there's very little that the government does that's actually a benefit. Most of it is a net negative. But we have to pay for government, right? Once we decide we're going to fund government, we got to cover the cost. And I believe that tariffs do less damage than the income tax. So if given the choice, I would rather pay with tariffs. Now, the problem is the government is now so big, you can't run it on tariffs. But 150 years ago, yeah, no problem, because the government was tiny. It hardly did anything, which was a good thing. And you could pay for it. But now the government is so enormous that tariffs alone won't do it, right? You need an income tax. You need a Social Security tax. You need all these taxes if you're going to have all this government. Now, I'd rather get rid of the government, and then we can get rid of a lot of the taxes.
Well, we've also had the recent announcement of Chinese insurers being allowed to invest in gold. Is that going to be a new big source of demand going forward here?
I think it'll be a source. I think that if they were legally prevented from owning gold, gold's been a very good performing asset. It's actually beaten the stock market over the past 25 years or so. It's up 10x. The Dow's not up 10x over that time period. So, it's done well. And so I think it's a good portfolio insurance. It's something that I think if you add it to your portfolio, it reduces the overall risk of the portfolio. So I think these insurance companies would probably want to have some gold in their portfolio. So sure, I think, they're, as a new buyer, it will, obviously at the margin impact the price. I don't know how much they're going to buy, but I do believe that over time, a lot of institutions that are not buying gold will start buying it. I mean, the reason that gold has gone up is because central banks have been buying. The public has been selling, especially in the U.S. and Western Europe. Maybe in China and India, they're probably still buying. But Americans are selling their gold. We had net outflows all year last year in GLD. We had net outflows in all the gold ETFs, GDX, GDXJ. We've had a pickup in net outflows of, not outflows, but redemption sales at Schiff Gold. We're getting a lot more people than we used to calling up and selling us their gold. Hey, gold's $2,900. Hey, let me sell some. I can use the money. We're not getting a big increase in people saying, oh my God, gold's 2,900. Let me buy it before it goes even higher, right? We're not getting the, oh my God, I got to buy. I'm afraid to miss out on more gains. I better sell while I can before the price goes down. So we don't have any kind of speculative fever surrounding gold mining stocks. It's the opposite. So it's the central banks that have been buying. That's one of the reasons that the gold silver ratio, I think, is 90-1, because the central banks don't buy silver. They don't have the room to store it. I mean, that's not what they want. They want gold. It's generally the public that buys silver. And so when the public wakes up to the real inflation threat, and when they realize that they've been sold a bill of goods with Bitcoin and other cryptos, they're going to be looking for gold and silver. And there's not a lot of it. The supply, especially with the central banks buying gold, but there's not a lot of silver out there. So I expect prices to go much, much higher when the Americans and the Europeans wake up to reality. And the reality they're going to wake up to is stagflation, and that, inflation is here to stay. Inflation is not going anywhere. The central banks spent over a decade deliberately creating inflation as a policy choice. That was their goal. Quantitative easing is just a euphemism for inflation. They said we need higher inflation, and we're going to print more money. We're going to let governments go deeper into debt. And I kept saying, you be careful what you wish for, because you're going to get a lot more inflation than you bargained for, and there's no way you're going to be able to stop it, right? You're not going to be able to turn the spigot off. Mm-hmm. And so that's where we are. This is going to be the most inflationary period of time that the United States, Europe, Japan have ever seen. It's going to be way worse than the 1970s, because we were in a position in 1980 to put the brakes on inflation, because we had Ronald Reagan, we had Paul Volcker, we jacked interest rates up to 20%. 20%. Now, the highest inflation ever got on the CPI was 13, yet we had 20% raise. So this cycle, we had inflation go to 9, and the highest we got was 5.25. Clearly not enough, right? So we didn't do what they did, and they brought about the worst recession since the Great Depression in the early 1980s. Mm-hmm. But when they did this, when they went on this inflation fight, debt to GDP was 30%, not 120%. The average maturity on the national debt was probably at least 20 years, not 4 years. The U.S. was still the world's biggest creditor nation, not the biggest debtor. We were still running trade surpluses in 1980, not massive trade deficits. So we are not in a position to survive the inflation fight the way we did in 1980. Mm-hmm. So we were in a position, and we had the ability to end it. And the stock market in 1980, the Dow was 7-8 times earnings. I think the dividend yield maybe was 6% or something. I mean, the stock market was cheap. The Dow was under 1,000. The price of gold was 1,000. Mm-hmm. I mean, the gold and the Dow were the same price, right? I mean, you talk about cheap, right? I mean, it was as cheap as stocks were at the bottom of 1932, after the market crash. So we had cheap stocks. We had, interest rates were 13% on a 10-year treasury. So we were in the opposite position that we're in today. We have no ability to wage a winning war against inflation. That's why we surrendered already. That's why the Fed started cutting, because 5.25 was too much to bear. So the inflation is not going to end. It's just going to get worse and worse and worse. The only thing that could save us, I guess, would be AI and a massive productivity boom that could eventually bail us out. But that doesn't mean it's a bailout. It just means that we would have been much better off had we not had the inflation. But we could have such a massive productivity miracle that we could afford it, right? Because we'd be rich enough, we'd be productive enough to be able to deal with it.
Yeah.
But I don't know that that's going to happen quick enough. And the inflation that we have and the calamity that it unleashes, could really put on the back burner a lot of the AI, because we just don't have the capital to invest in it, because we squandered it.
Well, Peter, we're recording this on Friday, February 14th, and 3 out of the 4 big miners beat their expected earnings estimates. So why do you think gold miners are not reacting to gold being at their all-time highs?
Yeah, and the only one that went up on the beat was Barrick. Mm-hmm. It was up like 6.5% yesterday when it beat. It's down 2.5% today. But Barrick's trading at like 11 times earnings. I mean, that's a fraction of the market multiple, even though their earnings are growing dramatically. It was record quarter, record earnings, $1 billion share buyback was announced. But, I looked at the analysts who cover Barrick, and I looked at their 2027 estimates, and they're based on $2,600 gold. But it's already $2,900. Why are you assuming that 3 years from now, gold is cheaper than it is today? They just assume that the price is going to go down, but they assume the price of mining keeps going up, right? But the only thing that goes down is, so Wall Street is so biased to be negative on gold that they can never recommend buying gold stocks because they expect their earnings to collapse because that's their outlook. That's why the stock is so cheap. Agnico Eagle, which put out earnings yesterday, and it's down 4.5% today. They actually beat their earnings by quite a bit. I thought it was a pretty good report. Record quarter, record earnings, a big increase in profits, and the stock is down, right? If this stock was in any other industry other than gold, it would be up quite a bit. The most ridiculous one was Kinross. Kinross was down yesterday because it missed, right? It missed its earnings. So it was down like 6 or 7%, and it's down another 1 and change today. But so quarter over quarter, earnings were up like 82%, right? But the estimate was for 109% gain, right? And so, okay, the stock went down, but earnings were up 82% year on year. It was still a record quarter, record production. It's not like the stock was priced for perfection or anything like that. I mean, yeah, it had been going up, but all these stocks are still cheap. And again, gold, I think their average realized gold price was $300 lower than it is now. Agnico Eagle, its cost of mining was about $900 an ounce. That means they're making $2,000 an ounce. That's an incredible profit margin on your gold. You take it out of the ground for $900 and you sell it for $2,900. How many companies have a margin like that? Right? As the stock, and gold's going to keep going up. So again, nobody is paying attention to these stocks. Everybody is selling these stocks because they need money to buy NVIDIA. They need money to buy Bitcoin. Where are they getting it? Or, they sell their gold stocks. And as they don't perform, more people want to sell because again, it's a casino. They want to be at the hot table, right? They're at the gold table and everybody keeps crapping out. And they look over at the AI table or the crypto table and everybody's got this cheering and this is great. So that's where they go. But look, eventually these stocks are just going to take off in a very short period of time. I mean, I could see these stocks doubling in a week, maybe in a day, one day. I mean, so the key is you got to have them before because it'll be very hard to chase them. People will be afraid to buy them when they get a pullback. I mean, it'll right now it's easy. They're dirt cheap. I've got a gold fund, the Euro Pacific Gold Fund. EPIGX is the EPGIX. Yeah, EPGIX is the no load symbol. You can buy that at any discount brokerage firm. We've got a great portfolio that Adrian Day has built for us. We have a lot of real junior miners in there, not the fake juniors that are in the GDXJ, real small companies that I think could just go to the moon when investors start to take an interest in the sector, and they will eventually. So I think that's where the big money is going to be made. I mean, you want to find the stocks that people hate, that nobody is buying, and that way you get them cheap. And I've never seen a more bullish set of fundamentals for gold than there is right now. Yet nobody is there.
It seems like with margins expanding, with lack of capital being invested in this sector, with just the sector being so hated and a possible just reversion to the mean, reversion to historical gold owning dollars as a percentage of dollars in the world economy, as you said, hasn't been a more bullish setup.
Yeah, I mean, it really doesn't even make sense to buy gold at $3,000 an ounce when you can buy these mining stocks. Because when you're buying gold, you're buying above ground gold that has already been refined and made into a coin or bar. But when you buy into a gold mining company, that I'm talking about a producer, not like an exploration company, but a genuine producer like Agnico Eagle, like Barrick, like Kinross. The other one that beat was Royal Gold. Came out with a good report. They were up yesterday about 5%. You see what happened today? They were down. They were down almost 4%. So it made a new high today for the year. But so now after the beat, and of course, all of it happened because gold was down $40. Big deal. It's barely below 2,900. Who cares I think people were unwinding some gold silver spreads because silver was up over $1 early this morning, and then they sold into that all day, or they sold gold, and people. I think there was a lot of stuff going on, but these gold stocks should just be going up. But when you buy a company like Barrick or Agnico, you're buying the gold that's still in the ground. That gold's going to come out of the ground eventually.
Mhm.
And what you're paying right now to buy gold in the ground has never been cheaper relative to gold above ground. Right? So to me, I want to buy stock in these mining companies and have that gold, knowing that it's eventually going to be mined and sold for a much higher price than what I'm buying it.
Mhm.
And eventually, the gold that's yet to be mined is going to be assigned a much higher value than the market is currently assigning it.
Mhm.
And the higher the price of gold goes, the more that unmined gold is worth, because some gold is expensive to get out of the ground. Right? So let's say you're a big gold company and gold's at 3,000, but you have some gold that would cost you $3,500 to get out of the ground. Maybe you have a lot of it, but at 35, you're not going to spend $3,500 to sell it for 3,000. So that gold is really worthless to you, right? But if gold goes to 5,000, all right, it's worth spending 3,500. I make $1,500 an ounce, right? Let me go get it. If there's a lot of ounces there, it adds up. So, this is the economics of the gold mining industry. As more and more of their reserves become viable at higher prices. And so that's what's going to happen. So I think more people should be buying the mining stocks. My fund, you can come up with a separately managed account. We manage individual gold mining portfolios. Adrian manages them through Euro Pacific Asset Management. So if you don't want to be in a fund, you want to have a separately managed account, you can talk to the representatives. But this is where people should be focusing. We've got gold has gone up 10x over the last 20, 25 years. Barrick, I mentioned Barrick. Barrick is lower than it was 20 years ago. It's the stock, the actual nominal price. Imagine where it is adjusted for inflation.
Mhm.
But you could buy Barrick cheaper. Not AEM. AEM has gone up. I remember buying AEM for $10 a share after this rock slide. It went down from 15 to 10. I remember buying. I still have that stock that I bought at 10, and now it's at 100. But Barrick, when it was higher back then than it is now. Kinross too was higher back then. Kinross I think was a $20 stock back in the early 2000s. It's got to triple to get back there.
Mhm.
So this is what people should be buying. People will be kicking themselves in a few years if they didn't buy. And if you're not, and if you want to, you don't want to trust your own judgment. I think Adrian's the best in the business at picking stocks. That's why I hired him. But talk to go to Europac.com, talk to the representatives, read up about it. Again, you could just buy the fund anywhere, or talk to our guys. And in fact, if you don't have a brokerage account, you can just go to my website, Europac.com. You can actually buy shares of the fund directly on our site.
Mhm.
Without a brokerage account, you'll just own the shares in your name.
Mhm. Peter, you mentioned silver's price action this morning. Again, we're speaking on Valentine's Day here. It went up
That's
quite
why
a bit.
I got this red shirt for Valentine's Day.
I gotcha. It went up quite a bit before New York opened, and then on the New York Open, it went down quite a bit. Profit taking, whatever explanation you want to use. But do you see a time that silver investors are going to be rewarded for their patience?
Yeah.
Or has it lost its role as a monetary metal and is only industrial now?
Yeah, I mean, what I think might have happened is there was some people that were buying silver, and then some people decided to sell gold to cover their silver shorts because they had long gold, and that started bringing down the price of gold. And then silver eventually followed gold, and gold was down like $40. Silver, was about unchanged on the day. But that still is significant if you're, because a long gold, short silver bet is kind of a bearish bet on the whole complex. When things are really going to get interesting is when people start going long silver and short gold to hedge their long silver.
Mhm.
Because normally in a bull market, silver is outshining gold. And I expect that to happen as this ratio, closes. I mean, right now gold's down about $50 and silver's down 4 cents. So about unchanged. See, normally that wouldn't be the case. Gold down $50, silver would be down $1.50, right? So there is a lot of unwinding going on, I think, behind the scenes here. But also, we got some hotter than expected inflation news again today, the third time in a row. And, I think that initially knocked gold down, the big pop in export prices. But again, the markets have got that wrong. High inflation is good for gold. It's not bad. The reason they think it's bad for gold is whenever the algorithms, they've been programmed, when inflation comes out hotter than expected, you sell gold. Why? Well, that just means the Fed's going to have to keep rates higher for longer to win the inflation war. And those higher rates are what's going to hurt gold. But what's actually happening is the Fed already lost the inflation war. And that's what these hot inflation numbers are showing you. Because the Fed should be hiking, and they're not. And because the Fed is not hiking, as inflation is accelerating, real interest rates are falling. Doesn't matter what they do with nominal rates, real rates are coming down. And that's very bullish for gold. And in fact, runaway inflation that the Fed can't control is extremely bullish for gold. And that's where we are.
Well, Peter, I think that's a perfect place to wrap up for today. Is there anything that you want to leave our listeners to think about before we do?
As I said earlier, I think these gold mining stocks are the gift that will keep on giving if you, don't look it in the mouth and just, get in there. And, again, the best way to do it is with our help at Europe Pacific Asset Management, either with my gold fund or the separately managed accounts. And we also have a lot of other funds that I think will do very well in a stagflation environment with a weakening dollar, which is what I think is going to define the rest of this decade. But also, I've got a new free newsletter at schiffsovereign.com that people can sign up for. We also have some premium letters that you could learn about and sign up for. The introductory premium is still pretty cheap, so you might want to, give that one a try. But there's a lot of content available even on the free one. We're putting out stuff every week. I do my podcast once or twice a week. I would suggest that people listen. You can listen on my YouTube channel. You could also go to Schiff Radio, or my podcasts are on, iTunes or any of these platforms, Spotify, Stitcher, anywhere that you can listen to podcasts, mine will be there. So make a habit of listening, but, subscribe to my YouTube channel. You get like a little alert because I do them live with video too. So if you check them out on YouTube, you'll get the video. Sometimes I do some spaces on X. X is my most active platform. I'm constantly posting on X. I do all my own posts. So you're reading my thoughts. I've got just over 1.1 million followers now, so gaining some traction. So definitely follow me there and encourage your friends to do that. In fact, I'm on Facebook, Instagram, TikTok. So anywhere there's social media, you should try to find my account and follow me and encourage more people to do it. You got to spread the word. I'm not on the mainstream media very often. I mean, nobody really wants my perspective. The left doesn't want me on because they don't want me criticizing the Democrats, and the right wing don't want me on. They don't want me criticizing Trump, right? Because everybody, is making mistakes, and I point out the mistakes that regardless of party affiliation. I mean, I encourage my listeners to vote for Trump. I would have voted for him myself. Actually, I did, but it didn't count because it was Puerto Rico. But it's not a panacea. It's not we have a huge problem that we're going to have to pay the piper. I'm glad we're exposing some of the corruption. That's a step in the right direction. But the real cuts are not going to happen. And I think we've been in recession all year. That's why Trump got elected. I think it's going to get worse. And the media is going to blame Trump, unfortunately, for it. But you need to be prepared. You can hope for the best, but I think you better be prepared for the worst. Murphy has a law. Anything that can go wrong will. And believe me, there's a lot of stuff that could go wrong, and a lot of it will. So get prepared.
Absolutely. Well, Peter, I appreciate you being out there and spreading the word as much as you can. We'll do our best to do that as well. And we have to see you back on Rogan soon.
Oh, yeah. I haven't been on there in quite some time. So maybe you have to request it. I don't know what happened. I was on 4 times. And then, I haven't done it I know I haven't done it since he moved to Austin. So he was in LA, but Austin's actually a little closer for me now from Puerto Rico. Perfect. But anyway, Tom, thanks for everything, and keep up with the good work.
Thanks, Peter. You too. Always appreciate the time. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.